In challenging economic times, financial institutions must find new ways to grow and prosper. Solid markets poised for continued growth. Profitable, stable lines of business where volumes are substantial, but risk remains low. Today's lenders have an opportunity, an all-American industry that has always led the national economy in financial recovery. Now is the time to consider making RVs part of your institution's lending portfolio.
I feel very excited about the RV industry and its future. And let me tell you why. Because we know that RVing and the lifestyle of RVing has become more and more popular over a number of years. Our customers have not left.
People haven't given up on families, haven't given up on enjoying the great outdoors or wanting to inculcate their values in their family through this recreational resource. And that goes well beyond any issues of the cost of energy or anything like that. These are basic appeals of the industry in any environment and are especially important now.
Why can financial institutions expect strong growth in the RV market, despite the current economic downturn? RV ownership is at record levels, with more than 8 million RVs on the road. In fact, 1 in 12 vehicle-owning households own an RV. As the economy begins to recover, consumers will demand value in travel and recreation. RV vacations rank between 27% and 61% less expensive than other types of travel. And RVs represent spending time with family, enjoying the great outdoors. A way of getting back to basics that is sure to appeal in a more uncertain economic climate. Demographics also point to growth in the RV market. RVs are popular, of course, with America's growing population of active retirees, with 36% of current RV owners age 55 years or older. But most RVs are now owned by those 35 to 54 years old, with nearly half of all RVs owned by this age group. And the largest gains in RV ownership are among those 35 years of age and younger. The RV industry has leveraged these demographics by investing heavily in marketing designed to recruit new RV owners. The centerpiece of this effort is a national advertising campaign called Go RVing. Since its launch in 1997, the industry has invested more than $178 million and created more than 18 billion consumer impressions. 2009's What Will You Discover? Go RVing campaign features eye-catching online ads on highly visited websites, full-page print ads in top consumer magazines, and captivating television commercials.
What your child brings back from an RV trip is more than you can possibly imagine. What will you discover? Go RVing.
Capital's been tight for all the lenders, and once capital frees up, this is a market you want to be in. It has stability, it has profitability, has a long history of low-risk loans. It's just a great place to be for a lender, I believe.
Like any industry, the RV industry depends on financing to stay viable. And RV financing has been a large and active segment of the finance industry. Still, opportunity abounds for growth-minded banks, credit unions, and other financial institutions to become involved in the $15 billion per year new unit RV market. One avenue is providing retail financing for RV buyers. According to industry research, the typical RV owner is 49 years old. He or she is married, with an annual household income of $68,000. RV owners are more likely than the general population to own their own home. Based on data from RVIA's survey of lenders' experiences, the number of loans made to purchase an RV in 2007 was 170,479, and the total dollars funded was $7.7 billion. The number of retail installment accounts outstanding was 588,800, and total dollars outstanding was $23.4 billion. 68% of loans were made for new units and 32% for used. The average time on the books for loans for new RVs was 36 months, and for used RVs, 37 months. The average down payment was 12%. The median minimum amount financed was $46,875 for new RVs and $51,458 for used RVs. Retail RV loans are very stable, historically having low delinquency rates compared to other types of consumer loans. According to information released from the American Bankers Association in January, RV loans had the lowest delinquency rates among other closed-end consumer loans through the third quarter of 2008. RVIA's survey of lenders' experiences reports that the annual net charge-off of RV loans to year-end RV loans outstanding is 0.59%.
Floor plan loans are a great deal for lenders. They're a low risk. Historically, the business has been great and growing, so dealers have grown along with the industry, and they're stable. The dealers are stable and been around for quite a while.
RVIA's survey of lenders' experiences shows that the dollar volume of RV wholesale loans in 2007 was over $8.8 billion. Dollars outstanding were $4.9 billion. The annualized RV inventory portfolio turns per year was 1.94, and the average unit value financed was $33,715. Recently, RV loans were added to the list of securities eligible for the Term Asset-Backed Securities Loan Facility program administered by the Federal Reserve Board to increase credit availability.
I think the American public is looking for people that use TARP money to invest in America. And the RV industry is almost 100% built here in the United States. Why should you get into RV financing? Because of the profitability, the stability, the long history of growth of this industry, which is going to continue.
With a strong base of current RV owners, a growing pool of RV owning prospects, an aggressive marketing outreach effort, and developing consumer trends favoring the RV market, now is a great time to be involved in RV financing. Consider becoming a source of retail or wholesale loans for RVs. Your institution will gain a profitable and stable line of business, and your customers and community will be served as they look more and more to this unique form of travel and recreation. For more information, contact your local RV dealer or visit rvia.org.